Welcome, everyone. Today we'll explore the fascinating origins of modern accounting and dive deep into two fundamental concepts, debits and credits. Let's start by delving into history. The title Father of Accounting is attributed to Luca Pacioli, an Italian mathematician and Franciscan friar who lived from around 1447 to 1517. In 1494, he published a seminal book titled Summa de Arithmetica, Geometria, Proportioni et Proportionalità. This work marked the first detailed description of the double-entry bookkeeping system, a method still influential in accounting today. Remarkably, Pacioli collaborated with none other than Leonardo da Vinci. His groundbreaking approach earned him the enduring title of the Father of Accounting and Bookkeeping. Now let's talk about two core principles in accounting, debit and credit. Often abbreviated as Dr. and CR, these terms are foundational to the system of double-entry bookkeeping. In straightforward terms, generally signifies an increase in assets or expenses and a decrease in liabilities or equity. Credits represents an increase in liabilities or equity and a decrease in assets or expenses. Each transaction in a business affects at least two accounts. If a company buys equipment, the equipment account is debited to reflect the increase. Conversely, if it pays a supplier, the supplier account is credited to show the reduction in liabilities. Understanding credit and debit is crucial for proper financial tracking and accounting practices. Consider a practical example. If a company purchases office furniture for cash, the transaction involves two accounts. This increases, so we debit it. This decreases, hence we credit it. These entries ensure every transaction is accurately recorded, maintaining the balance in accounting ledgers.